$12 trillion. That's roughly what's sitting in American retirement accounts, 401ks and IRAs combined. For decades, most of that money has been mostly off limits to one specific industry, private equity. Too risky, too illiquid, too expensive for retirement savings people need to count on. That wall just came down. In March 2026, the Department of Labor proposed a rule creating a safe harbor for private equity in 401k lineups. It could affect more than 90 million Americans with a workplace retirement plan. Here's what almost nobody explains: the real costs, the real performance, and how it reaches your account automatically. Federal rules under ERISA made it legally risky for 401k administrators to include private equity. Fiduciaries have a legal duty to act in savers' best interest. And private equity's complexity, fees, and lack of daily pricing made that duty hard to satisfy with confidence. Following an executive order in August 2025, the Department of Labor proposed a new rule on March 30th, 2026, creating exactly that legal safe harbor. The change doesn't force any plan to add private equity, but it removes the main legal deterrent. The real exposure for most savers won't come from actively choosing a private equity fund. It'll come through target date funds, the all-in-one portfolios that automatically shift your asset mix as you age. The ones most people are defaulted into the moment they're enrolled in a 401k. A slice of that fund could start flowing into private equity holdings without a single decision from you. Without you making a single active choice. So what does this actually cost compared to what you're paying now? A standard index ETF carries an average expense ratio of about 0.14% a year. A typical actively managed mutual fund runs closer to 0.40%. Retail-style private equity funds carry a median expense ratio of 3.76% before sales charges that can add another 5%. That's roughly 130 times higher than a basic index fund. Private equity's traditional fee model compounds this further, the industry standard 2 and 20. A 2% annual fee on whatever you've committed, plus 20% of profits when the fund sells. Academic research estimates investors pay 5 to 26 cents of every dollar committed in total fees, producing an annualized fee drag of 5 to 8% off gross returns. That's not a rounding error. Over a multi-decade retirement account, a fee gap that size compounds into a genuinely enormous difference in what you end up with at retirement. Here's the part the sales pitch depends on you not asking. Does paying all of that actually produce better returns? The Center for Retirement Research at Boston College studied pension plans investing in private equity from 2001 to 2022. Their finding? Those plans produced a long-term annualized return of roughly 6%. Nearly identical to a simple 60-40 stock and bond portfolio, with none of the extra fees or illiquidity. The Financial Times reported that private market funds actually lagged large-cap U.S. stocks across 1, 3, 5, and 10-year periods. In 2024 specifically, private funds returned about 7% versus roughly 25% for the S&P 500. The pattern has gotten pronounced enough that some of the most sophisticated investors in the world are pulling back. The New York Times reported that Yale's endowment, a pioneer of heavy private equity allocation, was rushing to sell billions in holdings. One of the pioneers of this exact strategy decades ago. Now rushing toward the exit. Billions of dollars heading out the door. From the very strategy now being offered to ordinary retirement savers. Public pension funds already have deep private equity exposure, and the picture is genuinely mixed. CalPERS, the largest public pension fund in the U.S., held roughly $112.8 billion in private equity as of February 2026. About 18.4% of its total portfolio, up from 13% just 2 years earlier. Globally, pension funds now control an estimated $68.3 trillion in assets. More than half of them allocate at least 10% of their portfolios to private markets. But several major U.S. public pension systems, Ohio, Oregon, Alaska, Maine, Texas, Nevada, have trimmed their private equity targets, citing compressed returns and ongoing liquidity challenges. Even McKinsey's own research describes the trend as pension funds becoming more selective and more focused on fee discipline. The institutions with the most experience and negotiating leverage are getting more cautious, right as this opens to ordinary savers. The pitch behind all of this follows a familiar shape. Most people settle for the ordinary option, but you, if you're sophisticated enough, can access something better. It's a compelling pitch because it flatters the person hearing it. But the actual research doesn't support the idea that access alone produces better outcomes. The fees are real, guaranteed, and paid regardless of performance. The returns have often failed to beat a simple, low-cost portfolio anyone can already build. As one major asset manager put it, any private asset allocation has to earn its place through real net-of-fee benefits, not simply through the appeal of being included at all. The vault from beat 1 and the crumbled barrier wall from beat 5 shown together in one wide frame. Camera holds both elements steady in the same wide shot. 8 seconds. And an asset class whose largest, most sophisticated investors are showing genuine signs of pulling back, right as the door opens wider for everyone else.
Financial security isn't just a dream. It takes informed decisions and a clear plan to achieve results like these.
Hit that like button right now. Not for me. Share it. Send it to someone. The more people understand, the harder it becomes to keep hidden. Like, share, follow.
Be sure to like, share, and follow.